Thank you, everyone, for attending today's webinar, Solar Power Financing, Where We've Been and Where We Are Going, brought to you by Solar Power World Magazine. We would like to thank Tuan Q. Pham from PowerFin Partners and Christian Hanelt from Clean Power Finance for being here today and presenting on this topic. I'm Frank Andorka, Editorial Director of Solar Power World, and I'll be your moderator today. Just a couple of housekeeping items before we get started. If you wish to tweet about this webinar anytime during or after, you can use the hashtag SolarWebinar. We will have a Q&A session after the presentations. Go ahead and submit your questions, and we will ask them after all the presenters are finished. Questions can be asked by using the GoToWebinar box on your screen. And presenters will be available to answer questions after the presentation. Our first presenter is Tuan Q. Pham from PowerFin Partners. Tuan is a managing director at PowerFin Partners, which is a manager of institutional funds for solar projects. Throughout his career, Tuan has focused on areas where energy and finance converge. Prior to his role in business development at Heliovolt, a thin-film solar company, Tuan covered energy and chemical companies at Morgan Stanley and Bank of America Securities in New York. And without further ado, I will hand the presentation over to Tuan Pham.
Thanks a lot, Frank. Really the idea here with this presentation is just to provide a basis for understanding how to price solar in the U.S. Given the incentive structure and given the cost of capital that we're seeing prevailing in the U.S. markets. A little bit more about PowerFin is that we are an institutional asset manager. We like to come into projects that are typically have a PPA in place. Minimum size of our projects is about 2 megawatts, and or roughly $10 million in value. And we provide the liquidity and work with developers to get those projects through to completion. And through different vehicles also will own and operate assets over the long term. So with that, just wanted to go ahead and jump right into the content section here. If I get these controls right. And so just to give you an idea of an overview of what I'd like to address. Initially, just talking about the different project stages of these projects. And the kinds of capital that are required at the different project stages. Next, moving on to the capital structures, and really more specifically the permanent capital structure, because that's where you have to begin in valuing these projects. And then that segues into overall project valuation, given certain cost assumptions, how to arrive at the value of a project to determine ultimately if it is a bankable or unbankable project. And also kind of tying that into how to arrive at a PPA price for a project given certain assumptions, and then in the end trying to relate that cost of solar electricity versus the grid, and ultimately parting with a few conclusions as to ways that developers and off-takers or solar electricity customers should be thinking about projects to get them through to completion. So the first slide here is just, it's titled Different Project Stages Require Different Capital Structures. And so there are really three distinct project stages. One is development, 2 in red is construction, and 3 is the operating or the operation of the asset. Just to give you an idea is that, in the notes here you can see development typically is going to be higher risk, it's going to be higher return. There's not going to be as much capital invested into the project. So if you have a $10 million project, for instance, if it's going to be valued at $10 million, or we'll use $30 million because those are the numbers that we referenced later on in the slides. So let's say that a project is valued at $30 million. The actual development cost of that project, the permitting and transmission, depending on the size of the project, the transmission cost may be higher or low. But it's typically a very small portion of that $30 million total check. And so the profile of most of the investors who invest in these development activities, they're typically going to be more, again, high risk, high return investors, being venture capital investors, less so now than there were before, 3, 4, 5 years ago. Growth equity investors, but moreover, because of the risk profile here, there's typically never going to be any sort of debt, at least in the development stage. Now, you can kind of try to tie these stages together, but it can be cumbersome to tie those stages together. So the second stage here is really the construction stage, and that's where the checks really become much larger. You have to pay the EPCs or the construction companies, and for the panels, you have to pay for the panels, of course, to get them put in place. So that's where your big checks come in. It typically, in our perspective, is kind of a medium risk or medium return type endeavor. The investors who are involved in these construction or bridge financing activities are private equity, not very similar to us, rather. Strategic investors, some panel manufacturers, for instance, strategic investors, are starting to participate in this construction or bridge type activity. Banks, and then, of course, specialty lenders. So the next is, and then the third stage is the operating stage. And that's going to be lower risk, lower return. But still the capital that's invested in it's going to be pretty high because that basically has to pay for, again, the total value of the system. Investors in this stage are typically independent utilities like NRG, like some of the very familiar names kind of bouncing around in the industry, infrastructure funds, and then of course there has to be a high level of coordination with banks and institutional lenders and also tax equity providers who would be involved in that part of the capital structure. So really we're at that stage of the capitalization. So the reason I circle this here is because that's what we're focusing on, because that's really where all of your value is going to be ascertained. And then you basically back into everything else. You back into the construction value, and then you back into, from there, the development value. So the next slide, and the next two slides really, we lay out just basically a very basic, and I would take this with a very big grain of salt because every single project is going to be very different. So we lay out in this slide and then the next slide. This slide is a cash grant example, and the next slide is an investment tax credit example, which is going to be the ongoing paradigm until 2016. And I've made note here that the cash grant in lieu of the ITC expired at the end of 2011. Now there are some grandfathering activities where there are projects that are quote-unquote grant qualified that'll also continue to complete through 2012 and part of 2013. But just to give you an idea of the relative value of these kinds of assets and how you arrive at the different parts of the capital stack. And just from a very basic perspective, is first you have to start at the bottom here, is determining the amount of senior debt that would go into the project, and ways that lenders determine how much debt they will put into a project. It's all predicated on how much cash flow that project is going to generate. And we do reference that in the valuation later, in a few slides later. But first you start with that debt. And one of the more critical aspects of that is what's called a DSCR, debt service coverage ratio. And different lenders are going to have different service coverage ratios, and everybody kind of mixes and matches a little bit, but it typically falls out in about a 1.3, 1.4 times range. And there are certain probability factors, P factors that are factored in there as well. And it's somewhat of a remnant of the wind industry and not necessarily as applicable in the solar industry because our resource is a lot more certain in solar. But long story short is, based on, say, 1.4 times debt service coverage ratio and based on the prevailing cash flows, it's kind of like determining if you have a property and it has lease payments into it or renters into it, you kind of back into the value of that project or the present value of that loan. And so the present value of this loan would be $17 million. And the next step is working through is the grant. And it's somewhat of an iterative process, but you have guidance that's been provided by the Treasury Department. And, but we do know, though, that the cash grant accounts for 30% of the system value. Since the system value is $30 million here, 30% of that is $9 million. So between the senior debt and the cash grant, you have $26 million. And then last, you actually back into the sponsor equity here, which is $4 million. So there has to be a $4 million amount of cash that stays in that must be invested in the project over the long term. And then, of course, that cash equity is going to receive some returns over the long term, basically what's left over after the debt is serviced. So then the next slide here is an ITC structure. And really, the senior debt, again, starting from the bottom, the senior debt is going to be the same, $17 million, because you still have the same amount of cash flows, and that's the only thing that lenders should care about, or one of the only things they should care about is the amount of cash flow here. The difference between this slide and the previous slide is really the white portion versus on the previous slide, the pink portion, the grant. So the white portion here is the ITC and the maker shield, or modified accelerated cost recovery system on the depreciation. Now, and I do make note here that you can't ordinarily bifurcate it, but just for our purposes today, I think it's a useful understanding to kind of bifurcate between the investment tax credit and the maker's shield. But in total, you can back into roughly $8.5 million of present value in the ITC and $3.2 million of tax equity. So, or rather, the maker's shield, coming to a total of 8.5 plus 3.2 is 11.7 million of tax equity contribution into the project, and then we can kind of back into the sponsor equity. In this case, it's only 2.7 million. The bottom line here is that if you are efficient with tax equity, then you can get a higher valuation for the project. But that's a big if, the efficiency of tax equity. And by definition, in my opinion, based on our experience, is that tax equity markets are relatively inefficient and inaccessible markets. And Christian, I'm sure, will have some comments on the topic later. But with that in mind, just going over to the next slide here, and it should be having a little bit of problem, but going to, I apologize, technical difficulties. Okay, so this slide here, actually it looks like the alignment got thrown off a little bit, but the formula in the green box should read, just ignore the system value portion here. It should be the left side of the equation. The right side of the equation is electricity output times the electricity price minus the annual operating expense, OPEX. All of that divided by the internal rate of return, or the cost of capital, minus the growth rate. This is really a very simple, yet elegant, in my opinion, way to look at the value of these systems. What this is also a form of is the dividend discount model. But all cash-based investments should, this is the basis of that analysis. And so just kind of ticking through the different components of this equation. I'll try not to get too mathematical, or this is more of a general conversation, but the big point here is, as stated in the title, is value starts and ends with long-term cash flow. And all this equation is pricing the value of that long-term cash flow, as you would price the value of a mortgage, as you would price the value of any asset that generates cash, or really any asset in the world. Ultimately, it depends on how much cash it generates. So going through each of the elements here, and I've highlighted in red the elements that, or the components of the equation that are most important. But first, the output. It's going to vary by sunlight and by system design. Overall, the sunlight is not going to vary very much, and if it does, then obviously we have a lot of problems. And secondarily, the system design here, from a bankability perspective, we want to be able to mitigate the variables in the system design. And that's why you want to have these, that's why these assets, the cost of capital should be, well, that's why system design is actually very simple. I'll just leave it at that. The next element here is the electricity price, this portion of the equation. So you have your output times your electricity price, and that's going to be the biggest variable, and that's what everybody's trying to arrive at, is what is the electricity price or the PPA rate that we should charge given our assumptions throughout the rest of this equation. Well, those are some things that we hope to just basically touch on in the next few slides. Operating expenses, that's the OPEX portion. That's your operating and maintenance expense, your insurance costs, and your site rent if you don't own the site, the underlying land on the site. So, so you take your electricity value output times your electricity price minus your operating expense. That's going to give you basically your annual cash flow. And then you divide all of that by the internal rate of return, or the cost of capital. And that's going to vary. This is kind of where the art and somewhat of the science comes in. It's going to vary by the off-taker credit profile, who the customer is, who's paying the check on a monthly or quarterly basis, the likelihood that they'll be able to do so over an extended period of time, a 20 to 25-year period. The sponsor strength, their understanding of the transaction, their balance sheet capabilities, or really how much money they have, the equipment reliability, and again, you should mitigate much of that equipment reliability. And one element that most people tend to overlook, and I would certainly take this as a big takeaway on this in this presentation, is the project size. There's a critical mass, and it's really for us no accident that we like to invest in projects that are over 2 megawatts in size, because there's a certain access to institutional capital that just isn't really there, and that institutional capital, however, is the only one that understands it. And then last, the growth rate. And so this will, if you run this equation, it'll give you the rough idea of what your system value is. Looking at this differently is, and while I'll try to be quicker about this, is what we've laid out here is a different way of looking at this. Along the left axis here is the cost of electricity in cents per kilowatt hour. And so assuming a system cost of $3 a watt without any sort of subsidies, we can arrive at, and again, this is just a placeholder, let's say 20 cents a kilowatt hour, no subsidies or anything. And this is, call it for a single axis tracker system. You've got a 20 cent per kilowatt hour number. And I caution everybody on this call not to use that number, because it's going to vary. It's going to be 20 cents to 40 cents, or 15, or 20 cents at the low end to up to 40 cents a kilowatt hour. But just use that, just bear that in mind. So then we back through for the grant, or 30% of that 20%, 6 cents. So then we're looking at 14 cents. And then we have the maker shield, which reduces the price even more by 3 cents. So then we're looking at 11 cents. And let's say that you can get economies of scale on some of these larger systems. So for instance, we can get economies of scale. So then we're looking at, before the cost of capital, roughly 8 cents a kilowatt hour. But then, of course, the investors have to make their money. And so let's say that it's on a blended rate, it's somewhere in the 10% range. That's 2 cents a kilowatt hour, or 10% of 20 cents. So what we're looking at is roughly 10 cents a kilowatt hour. I'd emphasize that the efficiency of capturing these incentives, the maker shield and the ITC, or the grant, or the tax equity in total, the efficiency of your capital, the cost of your capital, it's going to be very relevant to the total cost, or the PPA value of your project. Now, you can turn different knobs with the system costs, and people are certainly going to be aggressive sometimes about making those assumptions, but we would caution most to not get too aggressive because that is what, in the end, kills a lot of projects. So then the next slide here is, and it looks like it got thrown off a little bit here in the formatting, but this line, and I'll just kind of pretend, this dark line here is the average cost of retail electricity in California. And that cost is currently right about here, 13, 14 cents a kilowatt hour. And so in blue here, the cost of solar, the point is that at the bottom end, if you're very efficient with your costs, your incentive costs and capturing your incentives and your cost of capital, then you'll end up at the low end of the cost of solar, which is 10 cents a kilowatt hour. If you're inefficient at that, then you could be up to 15 cents a kilowatt hour. But therein lies the decision. Are you above or below grid parity? So if you're efficient with it, then you can take your project to a customer, an electricity customer, and say, well, I can actually provide you this rate at a lower price than you're paying to the utility today. Most people end up saying that they promise more, below 10 cents a kilowatt hour. Many people often do these things where they promise a price that's below what is actually feasible. And so we hope that this gives you an idea of what is and is not feasible. I mean, and I would qualify again all of this in saying that these are very general assumptions. The level of detail that goes into the analysis and the funding of these projects is significant. And but we want to be able to point people in the right direction so that they understand some things that need to be considered in funding projects. So in conclusion here, really we would just emphasize is that you should prioritize the elements that go into your equation or evaluation of your asset. But moreover, keep it simple. So prioritize. Number one, you've got to start with the PPA. You should know the relative cost of power and be realistic about those costs. So if you know that the customer is paying 13, 14 cents a kilowatt hour, we don't really see why it is that you should be offering your solar electricity at too much of a discount to that 13 to 14 cents. If you're pricing it at, say, 9 cents a kilowatt hour, there's clearly a disconnect, and that could also send a signal to that customer that you as a developer or you whoever you are may not truly understand how to finance these projects or how to price power, not just solar power, but just power in general, and understand what the cost of electricity is, period. So starting and ending with the PPA, you bear that in mind and you take all of these other factors into mind. So number one here is the debt. Lenders need investment-grade IG off-takers. You should be very cognizant of the coverage ratios that are required for lenders if you do have a lender. And also be cognizant of the fact that interest rates will change. We're in a very low interest rate environment today. But at the same time, there could be some spread compression over the long term. Number two here is tax equity. Just in general, tax equity is just not easily accessible for smaller projects. And in general, it's not available for projects that are smaller than, say, $20 million in value because there just simply aren't that many tax equity providers. And then number three, of course, considering the sponsor equity. If you're an independent developer or if you're just, you should eventually look for somebody to, it's not just having a balance sheet or saying you have a balance sheet, but it's actually understanding what it takes to get solar projects completed. So in summary, these are very complicated issues that work with each other. Most of all, we'd advise to just keep it simple, really use an unleveraged IRR hurdle, and these are the cap rates that are in the market of 8 to 9%. If it's below 8%, then it's going to be hard to get the project across the line, most likely. And then, in conclusion, if it does clear, then look for for a strong sponsor, and be careful about engaging advisors. I mean, oftentimes we do see deals that have 5 brokers in them, and of course, each one of those brokers wants a pound of flesh, and nobody knows why anybody's there. And so that has a tendency to break a lot of deals. But in the end, we hope that this empowers you to understand, to have a few questions to ask sponsors, have a few questions to ask other people involved in your project. And we think that it's important that those questions center around valuation and how to complete projects. So that's all I have right now, and I look forward to addressing questions during the Q&A session.
Thanks very much, Tuan. We really appreciate your insights into the funding. Our second presenter is Christian Henelt, a Senior Vice President of Renewable Capital Markets at Clean Power Finance. Christian has spent his career financing energy projects across a variety of energy sectors. He comes to Clean Power Finance from Tioga Energy, a leading developer of commercial solar systems. As the Vice President of Project Finance and a member of the founding team at Tioga, Christian was instrumental in both project finance and corporate fundraising initiatives. Christian?
Thank you, Frank, and hello, everyone. Thanks for having me. Wanted to spend a little time, as Tuan talked about, looking back and where we've been as far as solar project financing. I'm going to address, a little bit about where we are going. And a lot of where we were going, so I joined Clean Power Finance about 1.5 years ago to start their Renewable Capital Markets group, and I did so because I do believe that what we're trying to build represents an evolution of the solar financing market versus some of the structures that I and others have participated in the past. So if we can go to the next slide here, let me describe a little bit about the company, and we can go from there. Am I able to advance the slides, Frank?
Click on the first one in the center there.
There we go.
Perfect.
Okay.
Now you should be able to advance them the way you would normally advance them, either with a down arrow or return or whatever.
Thank you.
Yep.
So Clean Power Finance has been around for about 5 years now. We are a company was launched as a software platform for solar installers to use to manage their sales process. Basically, we replace the work of one or more full-time employees by allowing installers to be able to design, quote, and propose very polished presentations to both home and business owners to help sell solar. In 2011, early 2011, the company decided to launch into the financing space, raised some additional corporate equity from investors such as the venture arm of Google and Kleiner Perkins, as well as existing investors including Claremont Creek and Sand Hill Angels, etc. The focus has been on financing since the beginning of 2011, and let me describe how our business model is different and how we think that this is and ultimately a step forward for the whole industry and adding some structure and working with the various constituents. So what we see Clean Power Finance doing is sitting in the middle of an online solar marketplace where we connect the installers that presently use our software to manage their sales with investors who are looking to deploy capital into residential and commercial solar systems, as well as manufacturers and distributors who are looking to work with installers and investors to create demand for their products. Where I spend my time mostly is around this lower left-hand circle here. This is just a little bit more about the 3 customer classes and constituents that we serve. Really, the core customer is the solar professional, the installers, the electricians, the HVAC contractors, etc. Now, our business, we have over 1,550 solar installers that use our software platform to design, quote, and propose about 200 megawatts a month, about 7,500 to 8,000 systems per month, representing over 40% of the distributed solar capacity across the country. And you can see that this map on the lower right-hand corner is where our quoting activity and quoting volume is centered. So as you would expect, a lot on the West Coast, a lot in the Northeast, and then scatterings around the Midwest and Southeast based on local incentives or local industry. So this slide's a little bit grabby, but a lot of what we tell the capital markets is, hey, solar financing is actually, solar leasing on the residential side is actually over 75% of all residential solar systems sold are leased. And the reason they're leased is because it allows homeowners to go solar without the upfront capital costs and the pain of having to go out and buy a system. A lot of the ways that solar is sold right now is a solar installer or a consumer marketing organization telling a homeowner, look, you're tired of paying the utility, 17 cents or 28 cents, depending on what region you are, for electricity, and you don't have any control over your electricity bill. Well, take control of your electricity bill, pay a lower amount, lock in savings, and lock in volatility going forward so that you know that your electricity costs will either stay flat into the future or go up at a measurable rate each year. And the way that we, in turn, sell that to the capital markets as we think about this industry evolving and more capital coming into the space is, hey guys, financial institutions, financial capital markets love refinancing things. They love refinancing mortgages. They love refinancing credit cards. This is a utility bill refinancing opportunity. There hasn't been a utility bill refinancing opportunity ever in the past, and this is an opportunity to basically create a substitute payment for a consumer. What's growing as a larger and larger as a consumer share of wallet, which is their electricity bills. And so the solar is the medium to do that, but what really gets the capital markets excited is a new asset class that they can refinance. That market today is $90 billion a year of available residential consumer electricity purchases in geographies that are currently in the money, i.e. that a homeowner can save money by going solar at today. Now, one of the big things that Tuan talked about and I wanted to expand upon was the tax equity markets and the availability of capital. So to great publicity, the 1603 program expired at the end of the year. There was provisions for being able to safe harbor or lock in projects that will be turned on post-2011, so into this year all the way out to 2016, provided that the developers who manage those projects did certain steps in 2011 to safe harbor those projects. So if you remember, this 1603 program was put in place to manage around the fact that in the middle of the financial crisis, we had this tax credit for solar, but there were not that many financial institutions paying taxes at the time. They all were working their way out of huge write-downs, and that's still pretty much the case. There are very few pure play tax investors in the market today that will use only the investment tax credit. Most of them prefer the 1603 program because it preserved and added leverage to how many projects they could do with what little tax appetite they had. Others like the accounting treatment of the 1603 program better, and even others like some of the recapture provisions, some of the risk transfer and restrictions around transferring ownership of systems after they were turned online was easier with the 1603 program than it was with the investment tax credit. So if you want to look at what the capital markets look like today, and I'm particularly biased towards residential because that is where Clean Power Finance spends all of its time financing projects right now. There are To the left-hand column, there are very few pure investment tax credit financing sources out there today. There is Google, who's made a number of high-profile investments, both in residential as well as utility scale and commercial. We're fortunate enough to have them among our existing investors. And then there's a handful of banks. And some of those banks have done residential. Some of them have not. U.S. Bank has been the most prolific bank to invest in residential. But you also have folks like Wells Fargo and J.P. Morgan that are comfortable investing in projects where they get a tax credit. And then you have 1 to 2 and probably a growing number of strategic investors that are also learning how to monetize the tax benefits out there in solar. There is a bit of a belief that there will be more and more new entrants coming into the space. Secretary Chu has been encouraging the treasurers, some of the large Fortune 100 companies, to be able to look at this investment class because the returns are quite good. Nonetheless, it takes a long time for these deals, which are highly structured transactions, to get set up and deployed. So at least for some time, in my estimates, not until well into 2013, there's going to be a fairly limited number of tax investors in solar. Now, if you look at who's been investing over the last couple of years in solar projects utilizing the 1603, well, it's been all the other banks that are not yet necessarily very profitable, or at least the investors there cannot get access to an allocation of a lot of tax equity to deploy. There are strategic investors, manufacturers, folks like that, foreign investors. So think about with the 1603 program, you didn't even have to be a U.S. taxpayer at all to put money into solar, and so you'd seen a lot more overseas investment into U.S. solar projects. And as well, you saw private equity funds. So, one of the great ironies to me is that this mechanism, the tax credit meant to encourage investment in renewable energy, is only really available to Fortune 100 companies and folks that are managing the treasury at at profitable companies, not necessarily groups that are built to do investing, whereas private equity funds who live to do investing cannot monetize tax credits out there, but they could monetize the 1603 grant program. And so that, coupled with leverage, was creating quite a number of investments in the space. Now, my hypothesis is that there are a number of large developers out there who did go out and safe harbor a tremendous amount of equipment and thereby projects in the U.S. for the 1603 grant program. So I think if you look over the next couple of years, you're going to see a very interesting dynamic, and unfortunate for many small developers, which is the big folks have gone out and bought tens and tens of millions of dollars of equipment, which they are storing it for their pipeline, and they are going to be able to deliver to the capital markets billions of dollars of project opportunities that are going to be eligible for the 1603 program. And so you're going to very quickly start to see cost of capital bifurcate from the capital markets based on whether or not a project or a pipeline the developer is raising money for is going to be eligible for the 1603 program. And so I think you're going to see this period of time, second half of this year, first half of next year, where the developers that don't have 1603 pipeline are going to be having a very hard time raising capital, and the few banks that are able to monetize the investment tax credit are going to be in the catbird seat, and then the larger folks, the developers, are going to continue to be able to raise money from this longer list of capital sources on the right. I think it's going to amount to a fairly, you'll see a fairly strong beginning to 2012, and I think you'll start to see the effects of this enter the marketplace towards the end of this year and then the first half of next year, after which time hopefully some more tax equity investors will get into the space. But it will certainly create consolidation among the downstream and certainly result in undercapitalized developers having a very rough go of it. But let's not all get totally down. The good news is if you look far enough out, things get pretty rosy. So we did some analysis recently where we looked at the top 10 solar markets, both on the retail, residential, electricity side, and we said, okay, in 2017, when this investment tax credit goes away, and assuming a 8% cost of capital, which, as Tuan pointed out, there is a lot of risk around inflation and interest rates when you look out in this timeline. But touching wood and assuming that cost of capital stays roughly where it is, then there's $60 billion of annual retail electricity costs that can be refinanced with solar without the investment tax credit or any kind of state subsidy. That's a pretty big industry. And as you see the tax equity market potentially go away with the loss of the tax credit, you might actually see more, you certainly should see more liquidity in the industry, and ideally that will drive the spread between what current LIBOR or Treasury rates are at versus where it costs to raise capital for solar projects decline. And if that is true, then that can hopefully provide some downward pressure on interest rates in a rising interest rate environment. So I think that there's going to continue to be uncertainty in the short term and a fair amount of pain in the medium term, but if you look ahead, there's a lot of good things for solar, and being energy, this is an industry that doesn't evolve overnight. It takes decades to change and to solidify. Thank you very much, everyone, and I guess I'll turn it back to Frank, and hopefully we have some time for questions.
Sorry about that. Thank you, Christian. Thank you, Tuan. I appreciate it, and all of your insights today. We do have a few questions, so I'm going to go ahead and ask them. From Kiran, what will the development cost on average be for the $30 million solar project, maybe in percentage terms? I think that's directed at you, Tuan.
Yeah, it's typically, so that's roughly, call it a 10 megawatt project. It's going to be less than $10 million or $1 million. It's going to be probably less than $500,000. But it's really a matter of, so what happens is that it's really a matter of anticipating what the transmission costs are. And I would caution most and is right sizing and not necessarily getting on a transmission line when you develop projects, because that's going to drive your costs up, and you really don't need to be on a transmission line when you have a 10 megawatt project. You should be on a distribution line. It's much more elegant from a transmission perspective overall.
All right. From DJ, we have, is the IRR from one of your slides, Tuan, is that going to be the equivalent to the financing rate if it were qualified for a loan?
I'm not sure exactly which slide it is, but I'm guessing that it's the IRR, which is on the bottom left side of the equation, and that is what we would consider, that's the unleveraged IRR. So it is before the cost of debt. So your cost of debt probably is most likely going to be below that 8 to 9% unleveraged rate. So depending on the amount of leverage, and you can kind of weight it accordingly, you can arrive at some sort of leveraged equity IRR. So
okay, our next question comes from Russell. In certain markets, SRECs constitute a large percentage of revenues, and experience has been that it's difficult to get a fixed price for long-term contracts. Are standard tax equity and debt markets open to SREC projects?
Well, this is Tuan again. I don't know, Christian, if you have any comments on it, but in general, tax credit investors, they don't really care that much about SRECs because it's all, and this is again one of the differences, for instance, between the ITC and the PTC in wind, so they don't actually care that much about how the system is going to perform. They care to the extent that they can establish a basis for the ITC, and that basis is predicated on the cash flows that are generated from the asset. And again, starting at step number one is those cash flows are going to be predicated on, or the amount of debt is going to be predicated on the cash flows. And so, because going back to the SREC portion, is that SRECs, they are very volatile, and they don't tend to be very long dated, and oftentimes you have a litany of brokers in between who at each step expose that particular contract to that much more credit risk, which then makes it that much less attractive to an institutional lender, or any lender for that matter, because not only are you taking on as a lender against that, not only are you taking on the credit risk of the ultimate purchaser of the SREC, but you're also intermediating with additional credit risk of those who were in between that contract. So in the end, is that contract going to perform? That's a long question, or that's a long answer, but in general, it's much, much, much harder to get debt for projects with SRECs. And so that's why in those SREC markets, you tend to have a much higher contribution, if not 100% contribution of equity, because that equity is going to have a higher return, but also that equity should have a higher tolerance for risk or volatility in the SRECs.
Christian, you have any thoughts on that?
I agree completely. I think it's cutting to the chase. I feel like I'm down on a lot of things right now, but there was a window where you could get long-term contracts on SRECs that allowed significant leverage to be put on those projects, but I think that window's closed. SREC buyers are not signing particularly long-term contracts right now, and so there's not a lot of contracted cash flows from SRECs that you can borrow against.
All right, the next question comes from Joel. Does unlevered yield include tax benefits?
Yeah, so in general, what I would use is, that's a good question, is the industry uses roughly, so let's say that you have a $30 million value project, just basically take out 20 to 30% for the grant/ITC. So if you have a $30 million project, then your denominator for your IRR, or your denominator, your beginning capital investment should be $21 to $24 million.
All right. The next question comes from Mark. What types of rates are tax equity investors expecting in the post-1603 grant era?
I think it depends on the project, of course, but I would say that for a very, an investment grade type project with a utility scale counterparty, I think you're going to see, pricing in the 7 to 9% range, maybe 7 to 10, and then I think for projects with, less creditworthy components to it, you're going to see tax equity pricing as high as 15%.
Yeah, if I could elaborate on that, I think that, Christian, your single-digit IRRs, that's going to be for generally much larger projects or portfolios of much larger projects. I mean, otherwise it's few and far between. And in fact, and actually I would reference the news section of our website, powerfinpartners.com. We actually have published a number of articles in various publications, and we have presentations on there talking about some of these issues. But our experience is telling us is that tax equity tends to price on a cents on the dollar basis instead of on a yield basis.
Our next question comes from Jason. What do the panelists see as the effect of the upcoming anti-dumping tariff decisions against Chinese photovoltaic panels?
Sorry, say that
on
again,
project
Frank?
financing. What? Sorry. The question was, what do the panelists see as the effects of the upcoming anti-dumping tariff decisions against Chinese PV on project financing?
So it hasn't really filtered through yet, so I can speculate. But my speculation is that it will affect things very little. I think that the reductions in panels costs are not purely a function of dumping, but of reductions in the cost of silicon and transition to more and more low-cost overseas manufacturing. And so I think that those dynamics will continue, and you might see a stabilization in prices or a slight increase, but in the grand scheme of things, it's not going to be a very meaningful impact on project financing.
Yeah, I tend to agree as well. There should be de minimis impact, and I think that the whole kind of dumping issue is how do you make a panel? What are the components in the panel, and where is that made? I mean, it's a circular. I mean, it's almost a circular conversation. Does that which part originates in China, and who subsidizes which part? Capital markets and markets in general are fluid, and these manufacturers, they'll get a definition of what that looks like, and through manufacturing alliances or whatnot, maybe in the end we just buy all of our panels from Korea or Taiwan.
Our next question comes from Solar Power World Editorial Advisory Board member Justin Barnes. Christian, in your 2017 calculations in grid parity, was your reference to the ITC expiring meant to mean the total expiration or a reversion from the 30% to 10%? It was his understanding that the ITC will revert to 10% in 2017 rather than disappear altogether.
That's true, it does. I removed it entirely with the hypothesis that the structuring costs of monetizing the tax credit are going to exceed the value of monetizing it, so I just ignored it.
Yeah, one other note is that the accelerated depreciation has been in place since the modern day tax code in 1986, and that's not going to go away unless we have some wholesale restructuring of the U.S. tax code. So that is also another component of value that's back there, but does it make sense to price something like that at the margin if, on the one hand you have 10% ITC and then let's say that you get 10 to 20% value from makers? There's still some value that can be had from structuring it, but there are certainly restrictions on monetization of the equity during the holding period, the 5-year holding period, investing period.
All right, our next question comes from NND. SREC use may be limited to geographic domains. In those instances, how can such projected revenues be factored into the cash flow?
If there's no SREC contract, then it's going to be at the lower end of what most people's expectations are, or if at all. If there's no SREC contract and we can't define who the counterparty is, then it's virtually impossible to assign any value to that SREC. Therein lies somewhat of a willingness to speculate and or assume a higher level of risk. So therein lies the willingness of somebody to literally kind of take a gamble on policy, and SREC markets forming or becoming more disciplined. But there's a high level of regulation and legislation involved there, and it's really difficult to assign a value to that.
All right, our next question comes from Mark. Are there different rates that tax equity investors expect from SREC projects versus non-SREC projects?
Yeah, I think that question might have been asked a little bit earlier, but in theory, the tax equity investor should not care that much about that. They should care to the extent that the loan will perform and that the sponsor equity, the cash equity, is made whole on their return expectations. Because if those don't happen, then it compromises the tax equity agreements.
Our next question comes from Caitlin. Do you think we are likely to see another DOE loan guarantee program?
This is Christian. I personally do not. I mean, it depends on the election, but
I wouldn't necessarily count on it. And I think that actually, Christian, you brought up a good point in one of your slides, is that the longer, and this is our opinion solely, but the longer we, as an industry, rely on or expect additional incentives, the more kind of chilling effect that has on the projects that we currently have that are actually in the money. Because if it's in the money and there's a possibility that it could get a loan guarantee, well, I'm going to hold out for the loan guarantee and make even more money. And so that creates this vacuum of projects that never complete. So I think actually it's somewhat of a dangerous proposition to expect additional incentives out there. I mean, cost of systems has come down quite a bit.
All right, and our last question comes from David. Tuan showed a slide with a capital stack including debt and tax equity. I'm under the understanding that most tax equity on DG scale will not allow for debt ahead of them. Am I wrong about that assumption?
Well, it depends on the agreement, but generally I would say that tax equity on DG projects is an oxymoron. I don't think that it really exists. And if it does, then it would be under some sort of sale-leaseback facility. And so you shouldn't really care that much because the lessor is going to have tax equity interacting with their own debt under their own roof.
Well, first, I'd like to thank Tuan Pham and Christian Henelt for their presentations today. We really appreciate the information that you were able to bring to us. If you have further questions for Tuan and Christian, you can contact them at the emails that you see on your screen at the moment, or you can send the questions to me at F, as in Frank, Andorka, ANDORKA, at WTWHmedia.com. Thank you, everyone, for attending this webinar from Solar Power World. This presentation will be emailed to everyone later today, and it will also be available at www.solarpowerworldonline.com.
Thank you.